Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friend Sam Clement. Sam, say hello.
How's it going, John?
Sam, I'm doing okay. You know who's not doing okay this month?
Who's that?
People that bought 10-year treasuries at the end of July. Guys, we have seen yields on longer-term U.S. Treasury securities back up 20, 30 basis points, closer to 20. And that just kind of begs the question, as we take a look at it, we're probably near the end of this Fed tightening cycle. But the Fed just really only manipulates a couple of overnight rates, right?
Yeah.
It doesn't really have anything to do with the long end of the curve. Well, indirectly it does, but directly it really doesn't. Long end of the curve is really more based off future inflation expectations and the desire to have a real rate of return. So, Sam, you tell me, is 4.2 kind of where the 10-year Treasury is right now? Is that the stopping point, or what's going to happen moving forward?
Well, I think no one knows, I think, is the easy answer. You see people on both sides be pretty confident about it, but you're right. Everyone's always learned that's in this industry. The Fed sets short-term rates. Really, They don't even have to do anything but tell people what the rate is now.
That's right.
But longer-term rates, it's pretty much supply-demand based on inflation expectations and economic growth. I mean, probably a few other things, but largely speaking, where rates are going over the long term, which is economic conditions and inflation.
Well, that's the way it's supposed to be. That's the way I learned it in business school. All of that good stuff or bad stuff or boring stuff as it was at the time when I was studying it. However, we seem to get away from that a little bit after the financial crisis, 2008 and 2009, particularly after the pandemic, where the Federal Reserve and the powers that be just did whatever they could do to keep longer-term inflations and short-term inflation, not longer-term interest rates and short-term interest rates, as low as they possibly could in order to just continue to just goose the economy. And now all of a sudden it looks as though maybe they're not willing to do that any longer. So when we get back to normalcy, well, it's not going to feel all that normal to a lot of people.
No, and we've talked about it, again, supply and demand being a part of it, and Treasury's going to have to refill their coffers after getting, dangerously close to defaulting on our debt, I guess. They need to refill their checking account.
So I would tell you that, Sam, it's been probably since 2007 that we've had any sort of normal monetary policy in the United States. And in 2007, that's 16 years ago, Sam, I'm pretty certain you weren't keeping up with what longer-term inflation expectations were.
Not as much.
Not as much. And so all of this, I think, is really kind of coming to a head because, while longer-term interest rates are supposed to be inflation expectations, a desired rate of return, all of that stuff, someone still has to buy the stuff. Someone still has to buy the 10-year treasuries that the Washington pumps out. Someone still has to buy the 5-year note, the 30-year, all of that. And as we look around the world right now, and just with so much debt out there, so much U.S. Treasury debt out there, some $33 trillion, not all of it's publicly traded, but still that's a ton out there, 33 trillion. Who's going to buy it? Understanding that really since 2008, the Federal Reserve has bloated its balance sheet up to $9 trillion bucks. It's about an additional $8 trillion worth of government debt in all its forms. Got some old agencies and some mortgage-backed securities, but treasuries as well. And then foreigners, and I don't mean that in some sort of xenophobic way, but foreigners have dramatically increased their holding of U.S. Treasury debt really this century from about $1 trillion in 2003 all the way up to over $8 trillion not so long ago. So you take a look at that, it's like the Federal Reserve and foreigners have allowed us to live beyond our means. What happens if all of a sudden they're no longer at play? The Treasury is still issuing $1.8 trillion of debt or something like that between now and the end of the year. If the Fed's not going to continue to do quantitative easing and we can't count on foreigners, just how high can the rates go?
Well, I'll answer your first question is who's going to buy it. I think we are. We meaning, every U.S. citizen.
All right. Well, you elaborate on that for people listening to Trading Perspectives.
People, I think fear-mongers talk a lot about how much of our debt is owned by China. There was even a commercial I remember being put out at some point. I don't even know the purpose of it or who paid for it, but basically saying that
people wearing red hats, do you think?
Well, no, I think it was the opposite. But basically the point of it was saying how much China owns us now. Yeah. They own all our debt. They own us. They can tell us what to do. China owns about, 10%? Maybe a little more, maybe a little less at times?
Well, the most recent estimate is that their most recent monthly estimate, I think it's fallen to 850 billion or something like that.
So it's down a little.
It's down a little bit. It got up over like 1.3 trillion at one point, but it's been a pretty steady downward trajectory. But then again, with the pandemic and everything like that, maybe their trade balances weren't quite as wide in any event. A lot of reasons why that could be. Even so, a recent article in the South China Morning Post suggests that this is deliberate on Beijing's part to get away from the increasingly politicized Treasury market and U.S. dollar. So I'm not sure if that answers your question. I'm just telling you what's happening out there.
So, yeah, it does kind of directionally answer my question.
Yeah.
But, first off, I guess it's not all foreign entities that own all of our debt that they can
banks,
control
insurance
us and tell us what to do.
companies, all
Social
that.
Security, all that good stuff. That's where a large majority of our debt is held, not in China or Japan, which are really the two biggest, I would say. I tend to think that there's maybe some other things going on. I think China would love to point the finger at us being what's caused them, and our foolishness is what's causing them to step away from U.S. Treasuries. But I tend to think it may be more of what you mentioned with why their Treasury investments have gone down, or the amount that they're investing in them has gone down. Trade balances, lackluster economic growth, you name it over there. I mean, there's talks. The Chinese index right now is in a recession, or is in a bear market now, down over 20%.
That's not surprising to me whatsoever, given Xi Jinping's kind of bellicosity towards, I'd say, the private enterprise system, just the private sector, just in general. That's my opinion of alone, not necessarily those of Oakworth Capital Bank. And any investment decisions that you make based on this podcast, you do at your own peril, I think is the best way of putting it. But Sam, I would say, are we in some sort of weird situation out there that when China's economy is doing poorly, and they need to have all that extra cash floating about internally, as opposed to, like stocking up on Treasury securities. So when China's economy is doing poorly, that leads to higher rates in the United States. Are we in that sort of environment right now?
Probably. I mean, that's the consensus right now. I would say there's always a consensus. It seems like
consensus
in the market.
on everything.
And I would say right now the consensus seems to be that longer term rate should continue to go higher.
Yeah.
And I don't know, I get it, and I think I tend to agree, but then I have a ton of hesitation anytime there seems to be such an overwhelming consensus on something.
Well, historically, you take a look at it and using Ibbotson data going back to 1926. I think most people in the investment industry have seen the Ibbotson data, and it says that medium-term U.S. Treasury debt or medium-term bonds historically have a rate of return around 5.1 to 5.5%. I forget which one it is, but that's always been kind of viewed as a proxy for the 10-year Treasury. But that's probably about right. Historically, rate of inflation in the United States has averaged around 3%, 2.9 to 3.1, depending on the year that the Ibbotson data comes out. You tack on 2% real return that investors might demand of it, and you get a 5-year Treasury. Makes sense.
Sounds good.
And so right now, we take a look at it. I'm just going to say, right now, you take a look at the TIPS market, and it seems as though 10-year inflation expectations are around 2.4%. You throw in a 2% sort of real return on there, you get 4.4%. Right now, the market has a 1.9% sort of spread that it needs. So 4.4%, but if you go back to the University of Michigan reading, I don't know why Ann Arbor needs to have its own sentiment gauge, but it does. If I had Jim Harbaugh as my coach, I would probably be feeling pretty despondent most of the time. Your thoughts on that?
Especially during the playoffs.
Sorry about that, up in the Midwest. But last week it said that, inflation expectations, at least according to the University of Michigan consumer sentiment gauges, around 2.6%, I think it was. So 2.6 plus a 2% rate of return. I think it's kind of, you take a look at maybe right now, at this point in time, we could say that maybe a 10-year at 4.6% is sort of the probable case scenario, maybe the upper range of the 10-year at this point in time. Maybe, but that's about where it should be. However, it does mean that U.S. investors are going to have to get comfortable with that and say, hey, I'd rather have 4.6% than whatever's behind door number 2 in the equity market. And when you take a look at just consumer behavior over the last 15 years, Sam, do you think U.S. investors are going to say 4.6% is enough to make me ambivalent between stocks and bonds, so I don't care what I do?
Look, I think it has an impact. Rates going higher clearly has an impact on all risk assets, but I don't know if there is a number that is enough to scare people off.
What's the number for you? 1,000? 10% probably?
I'd say more. Because part of that too built into the expected returns of equities, which should still be higher than the expected returns of bonds. And there's just a human, condition of wanting to take risks and wanting to almost gamble a little bit more, go with the unknown path that has at least a chance of much higher returns. That's always going to be a part of it. But earlier you asked, so who's going to be buying the debt?
Yeah.
So who is it?
Well, that's what you said. We're going to be buying it. And I would say once we get to that level, that absolute level.
And we didn't mean Oakworth.
Yeah, we're just we as the investment community. Once we get to a level where we're saying that absolute rate of return and that relative rate of return over where I think inflation is going to be over a 10 and 30-year time frame, I'm ambivalent as to stocks and bonds. I don't think we're there yet. I know I'm not there yet as an individual. I know you're not there yet as an individual. You might not ever be. However, that number is still probably about, we're at 4.2 or thereabouts on the 10-year Treasury right now. I personally would want to see 6% before I'd sit there and go, okay, I'm going to reduce my asset allocation from 80-20 down to 60-40 or something like that. I would need to see at least that. However, some other people might feel differently. For whatever reason, that magic bullet out there, that magic number of 5%, it's almost like buying something at $19.99. You catch my drift?
Yeah.
5%. You tell anyone, I need to see 5%. I need to see 5%. And so I think that's sort of the magic number out there for a lot of investors, even if they can't pull out a slide rule or calculator and tell you how they came up with it.
The other part of we that I meant too is, it's the federal government, it's Social Security, there's all these programs that what they do with their cash, and largely because of legal restrictions, is just put it back into Treasuries. Yeah. It's you're exactly right. It's
that's how the Clinton administration was able to run a phantom surplus back in those years. We had so many baby boomers putting into the system. We had such a high labor force participation rate because the largest generation in America's history was all hitting its peak earnings years. Social Security had a massive surplus that the remainder of the government just borrowed from. But that's beside the point. I'm sorry I interrupted.
No, that's it. But so we, as everyone listening for the most part is a part of the Social Security program. Yeah. For the most part.
Well, for the most part, we do have people overseas that like to listen. Actually, interestingly enough, people from Poland, Polska, was over the last 30 days have been our highest international audience.
Interesting.
I think so too.
So there's a lot of different. My point is there's a lot of different areas, and insurance companies. Yeah. Lots of people almost indiscriminately buy Treasury.
Almost inelastic demand.
They're price takers.
Yeah.
They're not price setters. They're not looking for a certain price.
Just need the duration. I just need the duration. I need to do asset and liability matchups, and I need the duration.
So is that enough to overcome, talking about, at the end of the day, it's supply and demand.
Yes, it is.
It's factors that impact demand for it and supply that we talked about with close to $2 trillion from the Treasury. Is there enough demand to kind of, talking about China slowing down how much they're purchasing Treasuries, probably at least somewhat due to their own economic pain. Is there enough to kind of fill that gap?
I would say right now, probably not at 4.2%. Again, going back to that number I just kind of threw out there, 5%, that's probably not going to be too far from estimate, I don't think. I can't imagine. 3% has been the historical rate of inflation going back to the 20s. The 2.4% you're seeing in the TIPS market, 2.6% you're seeing in the University of Michigan sentiment gauges. I wouldn't be surprised to see that trend higher moving forward. A lot of that is due to the fact that I don't know how we get down to 2% or sub 2% in turn on inflation and core inflation when we have so many mandates coming out of Washington this is what you have to do, this is what you have to do, all this investment in green technologies and what have you is going to be very expensive. And it's going to be very expensive for corporate America, for the government, but it's not necessarily going to increase our absolute level of output, if you catch my drift. We're just swapping capacity. And when you're swapping capacity at a high rate of money, inflation, or at high cost, all you're going to be doing is driving up prices across the board, if you catch my drift.
Yeah.
So, more money spent on the same amount of output, that means higher prices. That's just the way that goes. So I imagine, and I think that 2.4% number, inflation expectation 10 years, is going to creep up a little bit. And so as it does, it's actually going to be okay for U.S. investors, particularly those people that are looking for an absolute level of income. And then we get to that 5% number. And I think that's probably about when all of a sudden the mom and pop U.S. retail investors start saying, I'm okay buying U.S. debt again. That's my personal take. For you, it might be 13%. For me, at that point, it might be 6 or 7%. But everyone's going to be different. But in order to absorb the sheer avalanche of debt that Washington is getting ready to unleash on us over the next 18 months, I think higher rates are here to stay.
It begs the question what the Federal Reserve is going to do in regards to this. I mean, because they're essentially the biggest player in the space.
Yes. I mean, they were the backstop for years.
Yeah.
They were the buyer of last resort.
Yeah.
And so if they're not going to do quantitative easing, if they're going to allow stuff to just kind of dribble off their balance sheet, Chinese aren't buying it. They're still buying, but not as much as they were. They're not allowing everything to roll off, but enough where, hey, something, they're not absorbing the excess supply any longer. And so someone's got to do it. And so when I take a look at everything, I'm going, I think interest rates need to back up a little bit. And that's part of the reason why we still maintain an underweight to fixed income here at Oakworth Capital Bank. Again, that is our position, and any actions that you take listening to this podcast are at your own peril. So it's not an offer to buy or sell securities or investment services of any type. However, when push comes to shove, and I take a look at everything out there, I do worry about who is going to buy, at least at these rates. And if no one's going to buy them at these rates, then obviously we have to have higher rates. And so what does that mean overall for the U.S. economy moving forward? I mean, a perpetuity of much higher rates over the next 10 years likely means slightly lower than expected aggregate economic growth. Would you agree or disagree with that?
I'd agree.
So if that's the case, where do you think the U.S. economy is going? How much do you think the U.S. economy is going to grow over the next 10 years?
I think some of the question marks around that, because it's not debatable that higher interest rates have this kind of headwind effect. But the U.S. consumer still remains extremely robust. Yeah. Extremely robust. I mean, we've gotten all kinds of data over the last couple of weeks. That just
sit there and tell
what's retail sales.
Talking about the Atlanta Fed's GDP now
over 5%. Yeah. So that to me, I guess, is part of my hope in the sense that the consumers are debt. A big part of the debt. People talk about the $1 trillion plus of consumer debt that we now have, but the fearmongers don't account that for inflation either. It seems like people inflation adjust things when it makes sense for them to. And they don't do it when it doesn't make sense. That $1 trillion is not inflation adjusted. The consumers, to me, still has a lot of ability to go out and grow our economy. So we've seen it be a headwind for 18 months now?
Yeah. To a degree, yeah.
I mean, starting
with the increase in the overnight lending target, and prime goes from 3.25 to 3.50. Okay, someone feels it.
Yeah, and the consumer has remained extremely robust for the better part of 18 months.
It's been a weird, freaky last 18 months where the U.S. consumer has remained relatively vigilant in the face of higher interest rates. The stock market this year has remained strangely vigilant in the face of now slightly higher interest rates. And this is a complete reversal from last year when higher interest rates caused the stock market to completely fall apart and the U.S. economy post 2 negative quarters in the first part of the year. But since that time, it's kind of this weird sort of, okay, we're getting back to normal. A lot of folks don't really remember what normal looks like or felt like. but we're getting back, in my estimation, to a period of time where, okay, the U.S. economy can adapt to higher interest rates. It's just a question of what happens next, particularly with the amount of supply that's going to be out there, who buys it, and at what price.
Yeah, I just don't think it's some worst case scenario or some doomsday scenario that some people, again, fear mongers might talk about. But humans are resilient. The U.S. consumer is resilient. The U.S. government's pretty resilient, or what we've been able to do through much worse economic times. Higher interest rates, and again, it's all relative. Going from zero, yeah, it's much higher, but long term, it's not extremely restrictive. So I think, obviously the interest payments, all that, there's going to be concerns with higher interest rates, but I don't think it's, it ends our economy.
Well, I mean, kind of to take it really sort of down to the end here, if 5% is that number, because I don't think it's that doomsday number, Paul Volcker, 14, 15%, I don't think it's anywhere close to that, but if 5% is that number, and again, I've just kind of thrown that out there, it's almost sort of that red line in the sand, I need 5%. If 5% is that number, that's at 80 basis points away on the 10-year Treasury. Historically, the U.S. Treasury will have, 10-year Treasury will have a duration of about 8. Let's call it 8. 80 basis points times a duration of 8. All of a sudden we're going to see the principal value of the 10-year fall about 6.4%. Throw in that 4% coupon, and all of a sudden you have a negative 2.4% rate of return on the 10-year Treasury, and I think a lot of people can absorb that and not necessarily worry about that too terribly much, and just kind of collect their interest over the next 10 years and enjoy 5% rates of return. And that's kind of what I think is probably going to happen. I think that's a probable case scenario.
I agree.
About 10-year and 30-year continue to back up a little bit, but not to that Dave Ramsey doomsday scenario. All right. Well, guys, thank you all so much for listening. We always love to hear from you all. So if you have any comments or questions, please, by all means, let us know. You can always drop us a line at tradingperspectives@oakworth.com, or you can leave us a review on the podcast outlet of your choice. As always, if you're interested in reading more, hearing more of what we have to say or how we think, please, by all means, go to oakworth.com, take a look underneath the Thought Leadership tab, and find all kinds of exciting information, including links to previous podcasts here, Trading Perspectives, as well as links to our blog, Common Sense, as well as links to all of the various sections of our quarterly magazine, Macro and Market. All right, Sam, one last chance to have another opinion on this topic.
That's all I got.
That's all I've got today, too. Y'all take care.